Today our topic is an outlook from global markets with Aditya Shah and Mr. R. Sivakumar. So Aditya is a founder of JS Investments with over 15 years of experience. And today we have from Axis Mutual Fund, Mr. R. Sivakumar. Mr. R. Sivakumar is having experience in investments in stock market since 1998. You heard me right. So since 1998, so he had seen over 23 budgets, which many of us are going to see. Like I have seen only 20 budgets. Shivakumar ji, you have seen over 23 budgets. Isn't that amazing to learn from an expert and understand what the budget outlook is all about and its impact from the global market? So primarily our topic is its impact from the global markets. So welcome to our show, Shiva Kumarji and Aditya.
Hi, Shankarji. How are you?
Good, going good.
Yeah.
So we'll start off with Shiva Kumarji. What is your outlook for the budget right now?
Yeah, thanks, Shankar. Thanks for inviting me. I think it's an interesting first time I'm doing this with the Paytm team. So I think
Your audio is not audible, so if you can
oh, is
just
it? I'm sorry. If
come
I'm audible now, I'll try to speak up a little bit.
closer.
So yeah. So first of
Yeah.
all, thank you for inviting me to this session. It's I'm sure going to be a lot of fun. The way I think as you mentioned, I've seen over 20 budgets come and go, and what I have learned over the years is the noise leading up to the budget. We love to talk about it. We love to talk about it on budget day, and 2 days later, by and large, we have forgotten about it. And I think, especially in recent years, there are a few times when we have had some significant tax changes or significant announcements which have changed the outlook. So large announcements have happened in the past. Things like GST, for example, when it was introduced, it was a big change. But you can name these kind of sort of big game changer budgets. There probably been only about 2 or 3 game changer budgets in the last 20-25 years. I will say, with the benefit of the experience, is don't get too excited. It's important. It's important because it does set a tone for the outlook for macroeconomic policy for the coming year, or maybe in some cases many years. But let's also not oversell the importance of a budget. Having said that, of course, every year the budget does come up with some unique differences. In the context of global investing that you are talking about, obviously this time the big question is this whole inclusion in global bond market, bond indices, etc. So there are going to be some things which we will be opening that it is important. It's important to understand from a macroeconomic perspective, but let's not get carried away and expect some great insights for us to make investment decisions, let's say for next 5 years or 10 years on the basis of one budget announcement. Just an opening thought. I'm not trying to underplay it, but I'm also trying to temper expectations about what's likely to happen.
Great. It's very true. See, ultimately, as an investor, I personally know one thing: budget, good budget, bad budget doesn't matter. Markets will ultimately move up. So that's the best part. Very well said, sir. So Aditya, what's your view for this budget? What's your outlook?
Yeah. So as Sivakumar sir rightly said, that there is very little scope for the government to do anything as such on the taxation side of it, or a dramatic change on the policy side of it. All of that is already taken out with GST coming in. The government has very little scope on the indirect tax to
Aditya,
change
you're not so
anything.
clear. You're not so audible. If you can.
Not so audible. Okay, 1 second. Just one.
So I think I can hear you well. I think
Okay.
Can you hear me, sir?
Yes.
Now it's fine. Is it fine now?
Yes.
Yeah, yeah. So as Sivakumar
It's
sir rightly,
echoing. I think maybe your surrounding.
maybe my surroundings. So after this answer, I will just change over my earphones if that's fine,
Sure.
right? Yeah. As I said, that the government has very little scope to change on the taxation side of it, which is a very great expectation from a normal retail investor or a normal retail guy who's out there, that everybody gets some sort of tax off or the other. On the indirect side of it, the government has already taken out that with the advent of GST coming in, everything is with the GST Council. And on the direct side of it, the government has already made whatever changes it could, and it sounds very, very difficult for the government to change anything at this stage, other than tinkering a little bit here and there, here and there, here and there. So it is not a game changer budget as such, but what we need to see here is how the government pushes the development agenda. It is more of a statement of how the government wants to push over its policies, how the government wants to attract attract manufacturing in this country, give incentives to people to manufacture in this country, do China plus one in the global investing scenario, and that's how the budget will be lined up. And as we have seen, we've seen a dramatic downturn over the last 3 4 years in the economy. Now the economy continues to recover slowly and steadily. So the government will try to push over its development agenda as such in the budget. So broadly, it will not be a very populist kind of a budget, but the government will push the development agenda that is really there.
That's great. I mean, what you said is very true. And that's all. It's all, after all, it's everyone's guess. But yes, I also pray that they don't get into populist one. They should focus more on growth. So now this was all about internal. How about international? What kind of international events which will impact the market do you think? The current sense, Aditya.
For me, the markets are already little bit concerned about how fast the Fed is going to increase the interest rates. Slowly but steadily, valuations will start to adjust to lower liquidity that is there inside the markets. We have seen a massive run up in the markets over the last 1.5 year on the back of very easy liquidity that is there inside the markets. As managers, we have been always cautioning that the valuations are rising way too fast with respect to the company earnings that are really there. One of It is not a near-term risk, but the markets will slowly and steadily start to adjust to the new normal that is there. That cheap liquidity will no longer be available. The U.S. Fed will try to increase interest rates to counter inflation that is there. That is one of the biggest incremental risks that is there, and the markets have been cautious over the last 1 month with respect to what the Fed commentary is really coming about. Right, that is one part of it that is there. The increasing tensions between Russia and Ukraine are also one part of the risk to the market. If Because Russia is a very big producer of natural gas as well as oil, that could have a impact on the market, on the oil market and the natural gas market. So there are two. These are two or three risks that are there that play out.
Important
But
areas.
yeah, but I tell all my clients and every retail investor that is out there, good companies will always give you an opportunity if the market really corrects, and in the long term they will continue to make money irrespective of these short-term phenomenons that really keep taking place. Try to buy good companies at decent valuation. There's nothing as cheap valuations at this stage in the market apart from sectors that are really beaten up. So try to at least buy them at decent valuations so that you are able to make some amount of money in at least 3 to 5 years. However, market valuations continue to remain on the expensive side.
Thank you, Aditya. Shivakumar ji, uh, it's just an observation. Like, though we are all betting on the budget story, we are talking on that. But you see, in the last trading session, Dow Jones was up by 1.65% and Nifty was up by 1.39. Nasdaq, it was up by 3%, over 3%, and our CNX IT was nearly close to 3% up. So international events are something which we really cannot ignore, which I feel. So in this, with the IMF prediction of 9% growth, GDP growth of 9%, do you think we will be able to sustain that?
Yeah. So I mean, so my uh, so one is that, when you look at a global, some of these are global and some are local. I think let's look at both impact of the US Fed, and that's very important because many businesses now are inexorably linked to the global cycle, both macroeconomic
Yes.
cycles as well as interest rate cycles. And interest rates are particular interest to me because I also run, a large fixed income portfolio here. So obviously it matters in terms of where we see how the rates are, and how therefore rates also have an implication for valuations, right? As interest rates, so as they made a very important point that it has actually been easy liquidity over the last few years which have actually helped as sustain asset markets, especially equities. And it's concerns about equity, so concerns about that liquidity withdrawal, which is actually creating more volatility. And you mentioned the day, but if you look at the absolute ranges, the number of 1%, 2% kind of moves, absolute volatility, that suggests to me, and it's not, by the way, just stock markets, various other asset markets, whether it's crypto or bonds or gold or anything else, which is also exhibiting significant volatility at this period of time. The reason is, and by the way, that's also true about here. Everybody's asking the question: will RBI hike rates or do something next week, right? So, it's the reason is when you are anticipating a significant shift in monetary, they have already, in a sense, sent the message that first taper, which means to say that incremental liquidity getting added will come to an end by next month, there are approximately. And perhaps from March onwards, we should start seeing interest rate increases in the US. And this is important because the US interest rate, in a sense, is the benchmark or the discount rate that the whole world applies to all asset markets. So I think we have to watch interest rates, global interest rates, very, very carefully. On the positive side is clearly that the growth momentum at least appears to be reasonably strong. I'll a lot of metrics look strong simply because we are comparing to a very terrible 2020 or 20 early 21, right? So a lot of year-on-year metrics simply look good from that perspective. Adjusted for that, many industries are maybe, for example, in India also just growing compared to, let's say, the 2019-20 kind of level. So it's not like, we are seeing gangbusters growth. So if growth is tepid or growth is relatively muted, and you have a rising interest rate environment, certainly that's not that's the reason why markets are volatile. It's not to say that market recognize that there is likely to be some amount of additional volatility, at least in the near term, as the markets prepare for the next phase. And this has always been the case in the past, whenever we have seen a change. And it doesn't have to be change in terms of only increasing interest rates. If you see periods when the market switches to a decreasing interest rate environment, again, you see some heightened volatility as markets come to a new um, or move to a new era. Take a case, for example, in the last interest rate cycle of India, which was 2017-18, where RBI increased interest rates from, let's say, and tightened liquidity through almost entire 2018. And then, of course, we had a significant challenge. We saw all the credit issues with NBFCs and so on, ILFS, and a lot of issues. So it just, when you have interest rate cycles which has a tendency to slow down the economy, we must be prepared for what are the stresses that come ahead. But also this presents significant opportunities for us as investors. I always say, and this may count a little out of this thing, that I almost always wish for equity markets to remain weak. I mean, I believe I have a lot of years of investing ahead of me. When I put my money to work in the markets, I want valuations to be cheap. When I'm in my 60s or 70s or beyond, when I'm taking money out, I want markets to be expensive. Somehow, as investors, we think that, markets are going up is good. No, when markets are going down, it's good, because my money is going to buying stuff at a better valuation than they were last month or last year. I think this is very important to keep in mind. And if this change once in 2 years investment opportunity, if stocks are available at prices or valuations comparable to where they were a couple of 2 or 3 or 4 years back, I would really welcome that. And I see that already reflected in certain stocks, certain corrections which have happened. It's not just in stocks, in bonds also. Yields have moved up. The 10-year GSEC is let's say close to 670, and we are so in various markets now. I think you are at least getting reasonably compensated for the risk that you're taking. And I think that's very important. And I think when you look at it from a global perspective, for the last 10 or thereabouts, in the global environment, interest rates have been close to zero, which means you have not even been compensated for inflation in a safe asset class. So you've always gone into more riskier and riskier asset classes just to keep ahead of inflation. Finally, you're getting to a point where interest rates are above inflation. At least you can park your money safely and look for opportunities to buy instead of just chasing stocks simply because bonds are negative real interest rates. So I think there are going to be very interesting opportunities for investors, whether you whichever asset class you look at. Sometimes volatility, because I think we can use it to our advantage.
In this case, also, Shivakumar ji, I really doubt how aggressive Fed will be in increasing the rate, because it's first time in 10 years their treasury note touched 3%, which is first time since 2014. And I was just looking at the yield curves, like the 10 years and the 5 years yield compared to last 6 months, it's nearly flattening up. So very scary if they actually would try to tamper with anything.
Yeah, see, in the last couple of years, the Fed has purchased more than half of the new issued treasuries in the market. So effectively, the bond markets in the global bond markets never had to worry about treasury supply and who's going to
Hmm.
buy these treasuries, because the Fed bought more than half of all new issuance. In the last few months, that has come down to under a quarter of new issuance,
Okay.
and soon it's going to be zero because they would have tapered down to nothing.
Hmm.
And possibly in the next few months, the Fed itself will be selling treasuries into the market, increasing supply rather than increasing demand. So so we must be prepared for some amount of change in the yield curve structure. You're right. The long bond in the US yields are probably about 3%. But the fact is that, just go back to 2014, the 10-year US Treasury was about 3%. We are well below that. And 2014 is not that long ago. And even compared to levels that we saw in US Treasuries just 4 or 5 years back, you're still extraordinarily low. And in the US, when imagine a situation, we are crying, they have 7% inflation with a 1%, 2% kind of treasury yield. Situation has to change. Now, of course, the 7% is not going to last forever. It's going to come off quite sharply. But the reality is that interest rates have to go up, the Fed has to tighten. So that is a given. Your point is important, that will the Fed be able to aggressively tighten? Because
Yeah.
that matters when it comes to asset valuation. If the Fed were to over tighten, then what happens? Will the economy get impacted? Because that is the biggest question. If the Fed over tightens, the lesson we should learn is actually from the European Central Bank back in 2010-11. They prematurely over tightened because they saw global commodity prices, oil prices rising, and they thought that will become entrenched in inflation. They over tightened, and that led, if you remember, during that whole eurozone crisis, etc. A lot of that was down to ECB prematurely tightening. I don't think the Fed is going to make that same mistake. I don't think the Fed is going to aggressively tighten, but they will have to raise interest rates, and it's not just the Fed. Most global central
Of course.
banks will raise interest rates this year.
So also, this is now to Aditya. Uh, Aditya, the dollar retreated from its 18 months high. So currently, the dollar index basically is like around it's around 97. It's now at around 97 from 97.44. So it's actually dollar is now retreating. The oil prices also increasing. So, and also your Australia, UK, Eurozone, central banks meetings are all going to be in focus. So, considering all these about the rate cuts and also looking at the dollar, what does it indicate right now
See, as Sivakumar sir rightly said, that inflation is a problem just not in the United States, but across the
globally?
world. All central banks are facing the pressure because
Yeah.
they had pumped in huge amounts of liquidity to combat the crisis that COVID-19 had induced, really. So from there, from that point of view, it is already very clear that across the world and at some point in India as well, RBI will have to start hiking the interest rates as they see inflation becoming more and more problematic for them. That is the first point that is there, and equity markets will start to adjust slowly and steadily to this new normal that is out there. That is the first point that is there. The second point that is there is that oil prices are shooting up. They have crossed $91. That is there. It's all dependent on what is happening towards the European side of it, on Russia and Ukraine. A lot of it will depend how these oil prices move. I personally don't think that situation will get out of control, but you really never know what really happens and what really does not happen. A lot of natural gas supply comes from Russia to a lot of countries in Europe, and that could really, if there is a problem out there, uh, if Russia and Ukraine do not resolve their problems amicably, then the oil prices could shoot up, and which could really hurt us in the fiscal and the fiscal on the current account deficit that is there. So that is a problem that is there that we need to really monitor. And of course, interest rate hikes are there. It's There's nothing new about it. So that's about it. Those are challenges that are there, but as I say, these are short-term challenges. Since if you have a long-term view on the equity markets, if you have 10, 12, 15, 20, 25 year view, which I tell a normal client to do an SIP for, these are all short-term challenges. You should not worry about them. If you are a direct equity holder, nothing to worry. If you are a mutual fund investor, go ahead, do a SIP and sleep well over that SIP for the next 10, 15 years. Should not be a problem as such. These problems will come and go. Today, we are embarking on a tightening cycle. At some point in time, this will peak out and we will go on a loosening cycle. It goes on, it does not matter. However,
No, I'm
you have
just,
to,
the question
yeah,
was in terms of
yeah.
like, will it be impacting this budget? Our
No, no,
government,
no. No, no. Our
Ministry of
government,
Finance will be
see, on
taking.
the, yeah, on the budget
And
side of it, on the budget side, yeah, on the budget side of it, we should be on from the global macro point of view. We should be more concerned about how the what the government is really doing to attract a lot of foreign investment into this country. That is very important. The PLI scheme, the China Plus One factor that is playing out, what the government is really doing to loosen up a lot of regulations that hinder the inflow of large companies into India. For example, Tesla says that it faces a lot of issues in setting up a production line here, whereas they were able to set up a production line in China in about 180 days, right? So that statement of intent, the budget is all about the statement of intent that the government will try to give, and within that, on the global side of it, what the government is doing to attract all these investments will be very, very important. Which started with the 25% interest, 25% tax rate that the government gave to corporates. That is there. So that is what we need to monitor. Other than that, the interest rates cycle, how will it move? It will not really affect directly what the government is wanting to really do.
okay, so there is a question which has come from Uday. He's saying, opinion on the bullet train announcement.
Bullet. So I don't know on the bullet train announcement. I don't think there will be any specific. The work has started and it will
Shivakumar
continue to
ji,
progress. Yeah.
so
No,
what's your opinion on the bullet?
no, I don't know whether there'll be any. I mean, yes, see, these large flagship projects have effect than it has any effect on macroeconomy. I think if we the real positive that it can create, genuine positive, it will be measured if these kind of projects take the high speed rail networks. If they take off, the impact will be measured in, let's say, 10 years time. Very unlikely that it will have any impact even after the rail starts in the first few years, because really speaking, the delta comes when the technology is adopted to lay these new tracks and new signaling mechanisms, etc., then percolate to the rest of the system. That's really where, yes, it's very important that some of these flagship technologies get created, right? So I think in the economic survey there was a point about space ventures in India, right? Number of entities which have got into space ventures, which have really shot up in the last few years as the Indian government has opened up space for private sector. A lot of startups have started getting into it. Not that anything has necessarily transpired in the near uh, past, nor will anything likely to happen in the next few years. But when you take again a decadal view of this, these could be quite transformative. These big announcements, like opening up of new sectors like space or bullet trains, etc., I think will have a large multiplier effect. But maybe 10 years or 15 years from now, don't look at this as game changers for the very near term. But yes, they are very big and potentially very big for a medium term, like a 10 or 15 year horizon.
Right. And it's also more of a feel good factor for them.
And it's very important because some of these are not just feel good factor from an announcement effect, but it also sends a message to the entrepreneur investing for the future, right? So if you are, for example, an engineering graduate today, many people just get into this .com thing, right? Everybody wants to start a .com and do something. But if you start thinking in terms of where new technologies could be developed, if that could be in, for example, something related to high speed rail, if some Indian solves problem of signaling, some Indian startup, right? That those are the things that we really need to see getting built. Indian technology which goes into building some of these new technologies, and how it will get developed today we cannot imagine. But we see where young talent puts his energies. I think that's why this. It's not just about the feel good of announcing it. I think the real impact would be to see if an ecosystem develops around it, which can then build on this technology going forward.
So that's very true. Now, I'll just take it another question here. Now, not a question, basically, which we were just observing. Like the global warming and climate change is a real headache for our government currently. So, how is it going to impact our budget, especially if it comes to if you look at the auto sector? So, because of the global warming and the climate change, we have to come up with some kind of Bharat 2, from Bharat 2, Bharat 3, Bharat 4. Abhi now we don't know how much,
Yeah.
what kind of
Yeah.
pollution control clause they will come up with. So, what
Yeah.
do you expect from that,
So I was
from the
just
budget?
listening to the Suzuki call in Japan. The Suzuki chairman said this, that the auto sector is undergoing the biggest transformation that it has ever gone in the last 100 years. The transformation to EV will be a very big thing to watch out for the auto sector. It will not happen overnight. It will take 5, 7, 10 years for the technologies to get developed. But the time to start to look for the technology is now. Today, a lot of startups are investing a lot of money into EVs. For example, Ola has built a beautiful factory near Bangalore for its two-wheeler scooters that are really there. Of course, a lot of these startups will face challenges in terms of developing these scooters or four-wheelers or whatever it is. But it is very important to get this technology into our auto space that is there. Auto space is a very big employment creator and creates a very big amount to the manufacturing GDP. Around 50% of India's manufacturing GDP comes from the auto sector. So the government, already has a auto linked PLI scheme, which is putting thrust on the EVs. It has a fame scheme where it is trying to incentivize buying of EVs. However, in this broad budget, the government will try to push more of EVs on the auto side of it, more production related to EVs, companies which will be investing in EVs and startups. More importantly, right now, what is happening is a lot of these OEMs are taking the startup routes. For example, TVS Motors has invested in a startup which is in Switzerland. Hero Motocorp has invested in a startup which is known as Ather, which operates in Bangalore. Similarly, Mahindra has now invested in Hero Electric, which operates in the north. So what really is going to happen is that the government slowly and steadily will want the EV infrastructure and the EV ecosystem over the next 5, 7, 10 years to get built, and it will slowly start moving towards giving incentives to the producers, to the OEMs, so that they slowly push EV manufacturing, which is already happening with the FAME 2 scheme, but it is a very small scheme. The government has to do a lot more towards incentivizing that. And then comes the power infrastructure. On the power infrastructure side of it, the government has to give incentives to the EV players, the EV charging station apparatus makers to put the EV charging stations. For example, today Tata Power is losing a lot of money on their EV charging infrastructure that is there. If the government is able to give some sort of subsidy or some sort of mechanism is put in place where the payback period for all these stations is faster, then they will be able to accelerate the advent of the EV infrastructure that is there. And on the generating side of it, also, the government needs to start thinking towards allocating more money to generation, because as EV comes in, the power demand will really go up, and the government is investing very slowly on the infrastructure side of it. So on the EV side of it, the government is already doing it, but it needs to do a lot more. uh, if EVs are to become a reality, let's say 10 years, 15 years down the line from here.
I think what you rightfully said was specifically which you addressed in a way
Yeah,
auto sector.
yeah,
Let's say if you look at today the global climate change thing, it's not just because of auto but because of many other things as well. See, for example, the kind of petrol we use, do we add up to the sugar stocks? I mean, do we add up a bit extra ethanol? So if we do
yeah.
that, maybe that will help some sugar stocks. And again, the road projects which are coming up, I think they will also help and boost our getting more credits towards the climate scores. What do you say, sir? Shiva, sir? And that will also impact our steel sectors and other infrastructure sectors, isn't it, sir?
Yeah.
So we are
So
working towards the climate. At the same time, our other different sectors and infrastructure is also getting built up. Of course,
yeah,
auto
the
is
simplest way, the easiest way to cap emissions is to cap growth, but we can't have that, right? So you need to have a strategy which enables us to grow rapidly, but is not highly emissions intensive. It will be energy intensive up to emissions intensive. So the point Aditya made earlier about the fact that at the end of the day, the generators, let's say the largest producer of power in this country is still coal. You can buy an EV and very
And
happily
still
plug it in
run.
and say, I'm not making emissions,
Yeah,
but
yeah,
you
yeah.
know, upstream there is a whole ton of coal being burnt for your one charging, right?
Yes,
So
correct.
the whole cycle needs to be looked at, and EVs are it's just one cog in in that whole system.
right.
Highways is again a very important full step, but also highways are important from improving efficiency. The better the quality of your road, the
Yes.
more the mileage you're going to get, and
Yes.
that reduces energy usage. You come to a city like Mumbai, and every road has illegal what's that thing called, speed bumps, right? Now those speed bumps are one of the largest causes of fuel
Pollution.
emissions, because you have to
Yes.
stop and speed up and stop and speed up each time you go in. Instead of maintaining a steady speed, you have to keep doing that. So at some level, if you genuinely, if you want to look at, I'm going to do EV, you have to look at holistically what we can do to. So I mean, Europe, for example, for the first time is considering adding nuclear as within the green fuels definition. The nuclear is perfect, there is no emission. Yes, you have spent nuclear, what you have to do is bury it somewhere, right? Yes, in that sense there's emission, but it doesn't contribute to gases polluting
Yes.
gases in the atmosphere or in the water and all that, right? So at some stage, the imagine that we need whole story, the theory around what is emissions or what is environment, and it's something which I'm passionate about, that we have to now I recently purchased a car. I went for a petrol car because cannot justify this whole burning coal. I cannot justify, for example, where that lithium battery has come from, because it's all these technologies need to improve to become a sustainable. I cannot if you look at half the cost of an EV is the cost of the battery, and it's full of these rare earth elements which
Huge
are polluting
expenses.
in its extraction. So I think, yes, it's very important we go on the EV path. Surprisingly enough, and the viewers, that if you go back to 120 years ago, at the turn of the previous century, there were probably more EV cars on the road than internal combustion cars.
Oh.
EVs at one point of time were actually the leading kind of vehicles until the petrol engine became efficient, and it suddenly, and then of course the discovery of all this oil in the late 19th century, early 20th century, the reserves that came from Middle East and all these places collapsed the price of oil and led to the boom of combustion engines. So like that, you need another, you kick, which kind of gives that extra kick to electric vehicles that really makes it. Now governments can come some way by creating fiscal incentives, but then the markets also need to do their part. I think you need to have, let's say for example, the rising price of oil will at the margin convince many users to shift to electric rather than petrol driven, etc. I think the market also needs to mature in this respect.
Sir, what's your view on the debt crisis of China? It's because primarily, if you look at it, nowadays we are all a global citizen and all the economies are somewhere
it's
linked.
yeah, it's very important. I think it's very, very important, and people are probably because China is so the for example, the one of the large companies which has been now in the news for several months, which is Evergrande in China. They are looking at some kind of a bailout led by local governments, wherein the parent company will go bankrupt, but they will try to rescue all the subsidiaries or projects, etc. There'll be, and therefore transferring effectively the cost of bankruptcy to maybe local governments, etc. But local governments in China themselves are highly stressed and are highly dependent on the real estate. Negative feedback loop going on over there between the local governments and the stressed real estate sector. And it's Evergrande is just one name. There are at least half a dozen others who have defaulted or on the verge of default. So I think there is a significant stress coming out of China. This is not all bad news for the world market, because this means that China has turned around in its thoughts to slow down the economy. So for most of the previous 12 months, the Chinese government was actually tightening policy to slow growth, and over the last 6 months that has flipped around, and they are actually at the margin now, really trying to improve growth, general consumption, and at on the net that could be positive for global growth if they are successful in turning it around. Yeah, but it can be potentially big, because Chinese real estate, in terms of its impact on the Chinese economy, is nearly comparable to the Japanese real estate boom of the late 1980s, and certainly more than comparable to the American real estate boom, which happened in the middle of the 2000s.
Correct.
So just like the Americans had their 2008 financial crisis, and Japan had the lost decade. That China also has a significant, sort of loss of growth for a extended period of time. The only positive is that they have seen this happen in the US and Japan, so they probably know to intervene early. Japan's mistake was intervene very slowly and in half measures. US did intervene quite aggressively and I think reasonably successfully, and China will probably intervene even more aggressively to stave off a massive recession.
Also, recently that we have observed that if many of these Chinese companies, especially global, they're all exiting the global markets like Dow Jones and even Hong Kong exchange, they're delisting stocks like DD, China Mobile, China Telecom, primarily the telecom. Why is this so? Why are they getting delisted?
See, a lot of companies, the United States, there is a in the United States, the U.S. government is stopping a lot of these Chinese companies from accessing their market, because they don't feel that the access to market for U.S. companies in China is equal as compared to the access of the U.S. market for the Chinese companies. As a consequence of this, a lot of wrong things are happening for the Chinese companies that are there. One or two companies had to delist from the NYSE as well. That is there. That is a problem there. And exactly the problem, as Sivakumar sir really said, nobody exactly knows what is really happening in China. what is the extent of the slowdown that is there. Nobody actually really knows what is going on and what is not going on. So practically, what we really do is that we advise clients not to invest in anything that is really Chinese, because we don't really understand what is going on and what is not really going on. The level of disclosures are extremely very poor, and it is very hard to understand the data that is really there. And uh, as the entire world goes on an interest rate hike cycle, we are seeing that the Chinese government is doing the exact opposite, which is a very interesting phenomenon that is really playing out. The growth in China is very growth slowdown in China is very apparent, and which is led by the real estate downfall that is really happening. So that is very important, and that is why we tend to not spend time on analyzing the Chinese companies, because we already know that we will never be able to analyze them properly, because lack of data is a very important factor when you go and invest in China.
I somehow see that when they're like exiting the global markets, see in these, especially the telecom companies, I somewhere feel it's an opportunity for our telecom companies maybe to go in those markets and do well. That's something sometimes I aspire, and especially when China would be busy with their debt crisis, maybe our Make in India projects, our government can work on them. So
I was just studying. So the Chinese now, they're very smart. So I was just studying the balance sheet of top Chinese telecom companies in China. What you really find is that a lot of them are cash-rich companies. They make a lot of money, which gives them the power to invest in 5G, 6G, 7G, the technologies of the future that are going to drive the world over the next 5, 7, 10 years. On the contrary, if you see, the problem in India is that our telcos continue to be very stressed. Our telcos have one problem or the other, one demand or the other that keeps on coming up. So the dynamics are totally different, where these companies will continue to invest aggressively in technologies of the future and win the incremental money that is going to come in. However, in India, we will always be followers, but we hope someday we are going to change this, and we are going to have that kind of technological power across the world, right? But that will happen very slowly.
so can we expect something for our telcos?
No, not matlab, we are really struggling to invest in 5G as of now.
No, from
We
the
are really,
government,
really
I'm saying from this budget.
no. So they will continue
Some
to
breather.
help. So they will continue to encourage telcos to invest in the 5G technology that is really there, and that's about it. And the government has done as much as it could for the telecom industry. Of course, the issues are there, but they have had save a lot of companies. Two companies, they have practically saved two companies by taking equity ownership on both of those companies that are really there. Apart from that, the 5G investments will come slowly and steadily. That is there. Uh, Apart from that, the government cannot do anything as such on the, especially for the telecom companies.
So, Shiva Kumarji, what's your view on Indo-China front? Like Russia, Ukraine, do you expect something in these lines? And do you expect our budget may deploy a good amount towards defense sector?
I think the policy stance of the Indian government when it comes to the defense sector is that what is necessary we'll do. Budgetary constraints or uh, so I think that is a very fair way to look at it. Don't look at it from a budget constraint perspective, but rather look at it from what is needed from a strategic imperative. So that I think is just quite fair. We know that the India-China situation is quite bad. The repeated incursions, both on the J&K border, this side, Ladakh side, as well as on Arunachal, that seems to be continuously now happening. So this so-called OBOR, if you plot all the dots on the OBOR, it almost looks like that China is creating a noose around India. So the fact that they are taking a port in Sri Lanka, a port in Pakistan, all of this points to the fact that they are trying to, they see India as a strategic threat and they are trying to con. So do we have the ability to stand up to that in a defensive context? I would say the answer is yes. Do we have the ability? I mean, and do we even need to go on an offensive? Probably not. I think if we we just need to have that or a sufficient defensive deterrent that is enough to prevent a so-called hot war. But definitely, India China is going to be one of those big things to come. And this is a global alignment, right? So you have, as Aditya mentioned earlier, this whole issue with Russia and Europe with natural gas, and so on and so forth. And China is the world's factory, so in a sense, they have the control over many raw materials as well as intermediate products, uh, which goes into all of our homes. And so the fact is that is a positive and a negative. Negative is they have control over the whole world's factory system, and they can choke us off if they want to.
Yes.
But the negative is that they need our markets. They have all the factories set up, and if they keep fighting with all of their customers and we stop ordering from them, they have a big problem. So there is a limit to which this can probably stretch. I hope it's a peaceful end, and that's the way we have to assume. But I agree with Aditya. I think we have to be very cognizant of the strategic imperative when it comes to our investment decisions. So where we put our money, do we invest in companies which we don't understand? These are companies where not necessarily every company has like a global gap or an IFRS type of an accounting. They may follow very opaque accounting norms, etc., which are local to China, which we may not even be able to read their balance sheets in the way we typically tend to read an Indian company or an American company's
Yes.
balance sheet. So if you want stocks, please be very careful, is what I would say. And otherwise, stay with what you know, and that makes more sense to me.
So with the getting out of China and coming back to the global crisis of Corona, do you think this would be a good time actually? The pharma sectors are going to be benefiting now, or is it like this is the last swing of the Corona crisis and it's over?
So if I may take it,
Yes.
really, pharma companies are doing really well. They were doing, some of the companies were doing really well, irrespective of the COVID-19 crisis or not. COVID-19 has definitely added to the revenues of some pharma companies, but the real trend on the pharma companies is China plus one, especially on some of the chemicals. Let's say on the API side of it, the active pharmaceutical ingredient that is there. What is really happening is that China is closing down a lot of factories, and world over, top companies are looking for another supplier that is there, where China plus one does come in. So COVID-19 was a smaller trend that has played out across the pharma industry, but the bigger trend that has played out, the two, three bigger trends that have been really played out because of COVID-19. Of course, China plus one on the API side of it. Was really happening much before the COVID-19 crisis. The COVID-19 crisis accelerated it. And of course, India is now beginning to be known as the vaccine maker for a large part of the world that is there. As India's demand continues to get fulfilled, these vaccines will start to get exported to a large part of the world that is there, on the African countries as well as the European countries that is there. And a lot of these companies are going to benefit. You are seeing a lot of companies doing vaccine tie-ups with Serum
India.
Institute. For example, Bygone is one of
Hmm.
them which has started their vaccine tie-up with the Serum Institute. So the larger trend on the pharma sector is what you need to play out, not the COVID-19 trends. COVID-19 revenues are there, were there, they
It's
accelerated.
just tip of the iceberg. Like,
Yes.
you'll have many other opportunities.
Exactly. The pharma sector is very small in this country, and as it continues to expand over the next 5, 7, 10 years, you will have a lot of good companies that come up, and you have to catch them. Of course, the COVID-19 revenues will can keep going up and down. We hope that no new variants come up which are which disrupt the economy. However, the larger trends need to be played where good companies are making a lot of a lot of inroads into the Chinese manufacturing that are there, and very good companies are making a lot of profits. For example, a company like Lotus Labs has tripled its revenue over the last 3 years, right? So and it's basically China plus one that's really playing out. So you have to concentrate there rather than on the COVID-19 crisis that will be there.
A very offbeat question. So this question I'm asking you, I don't know who will take it up. If both, any one of you can take up. Do you think anything is going to come up this budget related to cryptocurrency?
No, so the government has already tabled a bill in the parliament on how it intends to regulate the cryptocurrencies, and that's about it. I don't think that cryptocurrencies will be a domain of the budget that is there. That's my
Okay,
view. But the government really does not need to go there on a day when it is presenting its statement of finance. Is my view. That is there.
great, great. So I think we discussed about automobile sector. We somewhere discussed about the infrastructure sector, where also we spoke about the future. We spoke about, yeah, got some idea about Chinese investments and how to avoid them. Pharma sector. Is it? And also we learned a bit about agri center, where there can be new developments. But one sector which is like, I'm wondering, is it a good time to stick to equity or get into gold? Because this is the time where I see gold is also moving down. Of course, it's all because of rate of interest, high increasing of the rate of interest. That's the expectation which people have globally. Uh, so, equity market, if it corrects because of rate of interest, gold may also correct, right? So, where
So
should
let me
one
take that.
invest?
Yeah. So let
Yes,
me take
please.
that. I think it's interesting in the recent past that various assets have shown a strong correlation. So you have, gold, which people tout as being a big inflation hedge, and when you have global inflation surge, you have actually seen gold getting sold off. Right?
Yes.
You have Bitcoin again is people talk about it as the great or in general cryptocurrencies as some kind of great inflation hedge, and again have sold off in a period of high inflation. Between many of these individual asset classes, equities, gold, crypto, etc., they all seem to have increased in the last few months. So it's clear that something else is driving this other than an inflation view. And at one level, it has to be the Fed and the change in the liquidity stance. So if as long as your interest rates on bank deposits were zero, and in Europe you actually have to pay the bank for the luxury of keeping the money there, right? In many banks charge you a service fee for keeping a deposit. So if you're being penalized for keeping money in the bank, you would rather own anything else, and that could be crypto, or it could be gold, or anything else. Because gold at the end of the day is a 0% yielding asset. It has no coupons, right? And in fact, there's a certain cost to holding it because you have to pay for storage, insurance, etc. Right? So therefore, in a sense, it's actually a negative yielding asset. Every year you have to pay for it to be insured and stored. So the reason it does well is because your alternate asset is negative interest rates, and now that interest rates are going to positive territory across in some pockets rise above inflation rates, the need for some of these alternate assets as inflation hedge has gone down. I think that's one of the important things that has happened in the recent past, that there is expectation that fixed income will uh, use that, or will recapture that space as being an inflation hedge, that you will get a positive real return at some level. It's not today, but a few months, maybe a year down the road, whatever, you should be able to get positive real returns.
Oh, great.
And that's happened in India. I mean, for example, we were inflation with 10 years at 5.5 or 5.8%, etc. And now you have inflation coming down and GSEC yields going up, and therefore you have a positive real rate on Indian GSECs. And much the same way, the rest of the world also is likely to move to a positive real rate. So I think many of these alternate assets will have some challenging times. Not too many people know, because we look at Indian rupee value, that gold in global in 2008 globally gold prices fell during one very big risk off in a when you have hedge against risk off, right? When you have equity markets fall, you should have seen gold as an
Right.
alternate asset. but actually gold collapsed, and that time there was no inflation also. It was actually deflationary, and you actually had gold. So it's very, when you have these regime changes, you need to be careful. But let me give you one important caveat there. In 2008, the rupee fell sharply, and the rupee value of gold appreciated sharply. So
Yes.
where gold helps is not necessarily sort of the point to point inflation, but rather if you have a large change, like you mentioned earlier that, time, yes, but if you have a global risk off which leads to dollar becoming strong and the rupee weakens significantly, like we had in, let's say, in 2018 or 2013 or 2008, any of those kind of episodes, then gold will really outperform. So the way to look at gold, I think, in your portfolio is largely look at it as a sort of a risk hedge, especially from a currency risk hedge perspective.
Thank you, sir. So we'll start off with Aditya. I think it was quite interesting. Acha, someone has asked a question on P2P finance. Will there be any announcement on P2P finance?
So P2P finance is the ambit of RBI. Anything related to financial services will be under the ambit of RBI, and RBI will make necessary regulations to regulate P2P finance company.
So Aditya, we'll start off with you first. So it was a lovely session and we really all enjoyed it. And this is for the audience. We'll give this disclaimer out that we are not a SEBI registered entity or advisor or an analyst. The session was purely for informational purpose and to create awareness in the general public and does not constitute any recommendation or advice. All the views expressed here are personal and OCL does not bear any liability for the same. So this was the disclaimer. But before we go ahead, give me two things. Your last advice to the audience and two sectors they can bet on long term.
See, the last advice is tomorrow. The budget is a very small event in a large macro picture that will play out in their lives in the next 15, 20, 25 years. Don't worry about it. The government will take care of the things that it needs to take care of. Don't worry about it. And uh, if you are a mutual fund investor, continue your SIP irrespective of this event or not. That is the only advice that I keep continue to give our clients that is there. That is the first part of it. Second part of it, I always tell my clients is that you have to continue to invest in the stock named India. There is so much potential across all the sectors, across the economy, that as more and more penetration of each and every service continues to happen in the economy, the company, most of the companies will continue to do really well over the next 5, 7, 8, 10 years. However, specifically, if you ask me what are the sectors that I'm really very, very bullish on in the next 5, 7, 10 years, uh, see anything related to pharma. Pharma will continue to do really, really well over the next 5, 7, 10 years. That is one part of it. The second part of it is anything which is related to EV. EV is a very big theme that is going to come up. We don't know who is going to win or who is going to lose here, but it is a theme that is for the next not 10 years, 10, 15, 20 years, as the transition happens over an elongated period of time. We have to continuously see who does really well. It is anybody's guess. It's a wild guess, right? But it's anybody guess. But you have to continuously keep on having your view here. And if you don't know any of these things are very complex for you guys. Simple. Go ahead and invest in a mutual fund. A mutual fund manager will go ahead and simplify all of these things for you and get you a decent amount of return that is there. But invest in the country named India, continue your SIPs. Don't invest in the stock market without knowing the underlying asset that you are owning. And don't speculate just because the market is continuing to move up. Invest in good quality companies and sit on them for at least 10 years, and then you should be really doing okay.
Thank you, Aditya. Thank you.
Thanks.
Shivakumar, sir, your final words to all the audience who are observing you. So you have seen 23 budgets and more than that, but you have been actively watching 23 budgets. And this is one budget which we are all observing your and taking your expertise from that. Tell us your last few words on what should a retail investor do. and two sectors which you feel will do well.
Echo almost everything that Aditya said. Uh, uh, don't change your investment strategy because of a budget. Right. Start with what you want to do. What is your risk profile? What is the kind of stocks or other investments that you want to hold? That's more important than a point in time. Companies' results will dominate earnings, and the earnings that they generate will dominate performance, and that will lead to uh, stock returns or any asset class return over a period of time. Fundamentals matter more than anything. But I'll also give you another interesting insight. Do not, right? If you look at last 25 odd years,
Coming to
the NSE came into being in 1993, 94. It's about the time when India, interest rates in India also got liberalized. And there are GSEC prices available from 1993, 94. If you look at the period 1994 to now, the returns from Nifty and an index of government securities is almost the same. That means for more than 25 years, the returns from equities and government security identical. Equities are slightly outperformed. This is something which people don't understand, that there are long periods of time. And of course, if you look at the last several years, equities have outperformed massively. There's no question about it. But it is not obvious to me that for the next 5 years, 10 years, 15 years, there will be a secular equity outperformance at all points of time. Yes, over a period of time, do I expect equity to outperform? Surely the answer is yes. Do I expect equity to outperform in every 5 year period from here on for the next will be cycles? The only way that you can hedge yourself against cycles is to have an asset allocation strategy, whether that includes stocks and bonds only, whether that includes some global stocks or global bonds, whether that includes gold. That I cannot help. You need to go to your advisor, financial advisor, and they can probably help with that. But please keep asset allocation in mind when you're making an investment decision. That is going to be crucial for managing your wealth over a period of time.
Thank you, sir. Thank you very much. I'm getting a question aggressively from Uday, who is asking, sir, I'm asking on our budget capacity to allocate something around uh, 1,71,000 crore or even a loan from Japan banks like 90,000 crores or something. So they're not charging anything to us. The Japanese banks are not charging anything to us. Their bet is only it's they're also they're paying, they're not getting anything. Here also they're giving us zero interest. I think they're going to earn on the currency fluctuation. That's their bet. Isn't it, Aditya?
No, the question here is not clear. Generally, it is, for example, the loan payback period. Generally, what really happens is that on the loans, every loan has a different payback period that is there. Generally, what happens until the time is until the project is operational, there is a moratorium period, and after that, there is a payback period that is there. Generally, this happens on a loan that is taken from Japan that is there, because the interest rates are there are really very low, but currency fluctuations are really there.
Yes. So great. It was lovely, Shiva sir, the way you explained, and your last suggestion, Aditya's suggestions. If I just combine them up together in very simple words, do your risk profiling, do a good asset allocation, put your money in different products, government bonds, in debt funds, of course, or maybe in ETFs. Nowadays there are ETFs. uh, Equity, put your money in equity, allocate some funds in equity. And whenever you're planning to allocate some funds in international equity, do not even look at China, because there is a Chinese wall around it, so we don't know what's happening there. Aditya, am I correct with this?
Yes, yes, yes,
Yes.
yes, absolutely.
So, and also, then if you can't find the right sector, if you don't know which sector you're going to put your money in, just close your eyes and invest in Nifty 50 or Nifty 500 ETFs and just forget it. You buy the whole of the market. You don't know which stocks will do well. Yes, we spoke about speculations about auto sector may do well now. We speculated that even steel may do well. We know pharma may do well. But these are all speculation, and we are expecting these things from budget or in long-term growth. But forget the speculations. If the brain doesn't work, doesn't matter at all. It's very simple. It's very simple and stupid thing to do, and a very boring thing to do. Just invest in India because that's our country, and it's a global small cap. Because the GDP of India is the one. It's 3% of the overall global e- GDP, right? Or right? Sorry, global market cap, not GDP. I'm so sorry. So 3% of the Indian market cap. Indian market cap is 3% of the global market cap. So it is a global small cap. So invest in the small cap of the world. Invest for long term and make money. Invest in India. Don't try betting against it. Be it this budget or the next budget. Shivakumar ji is going to vouch that in the last 23 years of budget, nothing has changed. Only one thing has changed. India has gone up. India will keep on going up. And so will your investments and your returns. Thank you, Shivakumar ji. Thank you, Aditya. And thank you, you all lovely audience who had been there with us. And have a great investment life ahead. All the very best. Welcome. Thank you.